All right, welcome back to Mr. C's Accounting, where we're looking at income statements now. The other financial statement, let's get into it. Income statements. These are financial statements that shows a business's profit or loss over a period of time. So, remember how I said that balance sheets are like snapshots? They're x-rays, they're instantaneous. Income statements are not instantaneous. They're a report over a certain period of time, whether it's a week, a month, a quarter, or a year. If you don't know what a quarter is 3 months. It's a quarter of a year. Okay, 2 terms for you. Revenue. You guys should know this. It's money made as a result of sales. Expenses, expenditures that help a business generate revenue. So if we're going back to a bakery example, we expend money on buying flour and yeast and other things in order to make bread, and then we get our revenue as a result of selling said bread. And this is what we do to our customers. We scream at them to give us their money. That's how you treat your customers. I'm kidding. Don't ever treat a customer that way. Okay, BS in this case stands for balance sheet. IS is income statement. Both statements are equally important. They both have different purposes. Income statements do show profits. Remember, balance sheets do not. Yeah, and then are they important? Yes. So are you making a profit? That's a big question that income statements answer. Investors use this to invest. So they look at income statements and then they decide how well has the company done over, this month, quarter, year, whatever, and therefore should I invest. Bankers also use income statements to decide whether or not they should loan companies money. Banks are in the business of making money, so they're not going to lend out money to companies that are not doing well. And they use income statements to determine how well a company is doing. And income statements are also used for the purpose of paying taxes to the government. All right, 4 steps, not 5, so this is going to be shorter. 4 steps to prepare an income statement. Step 1, fill in the heading. It's the exact same format as a balance sheet, which is kind of nice, isn't it? We don't have to do a different style. 3 lines, who, what, when. Very straightforward, exact same thing. Except we write income statement and not balance sheet, but I'm sure you guys realize that. Next, I'm talking fast because I want to get the video done. I feel bad that I had migraines all day yesterday and part of today. I couldn't do anything, and I want to get these out to you, so that's why I'm talking fast. Our animations did come a tad early, but that's okay. I let you appreciate how magnificent they actually are. Here is an income statement. Very basic, but this is a good example. You'll notice a few differences. All the names of the items are listed on the left column. We have amounts here, and then we have total, final total. Okay? So we have our total revenue, total expense, and then final total for income, net income. There, see? So, when we operate with an income statement, these are increases to expense account, which by their nature should be subtracted from revenue. So, in terms of how we calculate net income, we have our sales or our revenue, which is $150,000. Now, companies are able to make revenue in other ways aside from sales. There are other things companies can do, but for this example, it's straightforward, just sales. So our total revenue is here. And then we have our various expenses. So rent expense, salaries expense, supplies expense. Now you'll notice these are all fixed costs. Now, depending on how complicated things get, variable costs will also be listed, although they'll usually be in the supplies and inventory or cost of goods sold, which we're going to talk about in a bit. So these are all our expenses, and then we make our total here. God, the rectangle. And then we subtract our total expenses from our total revenue in order to get our net income. 150,000 minus 25,000 equals 125,000. All right, step 2, organize the revenue section. So the money or the promise of money received from the sales of goods or services is called revenue. All sources of revenue should be listed. So as far as we're going right now, everything is lumped into sales. All the money, all the revenue that we're getting as a result of the sale of goods or services is lumped into sales. So we have revenue title, our element, which is sales, and then the amount, and then we have our total. And that's the revenue section. Pretty straightforward for now. I think that this is as complicated as we're going to go in this course. So our revenue section is always pretty straightforward. Next is the expenses section. Expenses is where things get more interesting. So our first type of expense is called operating expenses. And these are the costs required to keep the business operating. Again, the titles or the names of these terms is quite useful. So in terms of thinking whether something's an operating cost or not, ask yourself the question, is this expense required to keep the company operating? So for example, salaries are operating expenses because we need employees to operate, machineries or to keep the company running. We need to pay advertising expenses because the only way that our company is going to continue to operate is if we're selling stuff, and the only way we can sell stuff is if people know about it. So we have to tell them about it, right? Same thing with maintenance and utility bills. All these have to be paid in order for the company to continue operating. So these are all operating expenses. Now, the matching principle isn't something we're going to go into too much detail with, but it is a fundamental accounting principle that you need to know, so I'm going to teach it to you. Matching principle states that all costs of doing business in a particular time period are matched with the revenue generated during the same period. Now, this gives us a sort of Alice in Wonderland rabbit hole here, but all you really need to know is that we only recognize the operating costs that are associated with the sales revenue from the period. So when we write an income statement for a certain period, we only concern ourselves with the expenses that are required to get the revenue that we got during that period. Okay? So in terms of our income statement, going back to our example, here's our list of expenses. These are all operating expenses. So rent, salaries, supplies. Whoa. Now bear in mind, this is a service business. Jackson's shoe cleaning. So he's cleaning shoes. He's not selling any goods. He's providing a service. So right now, these are the only expenses we have to deal with. When you're dealing with a business that sells goods, so tangible items, we have a new section to add called costs of goods sold. And we're going to get into that in a bit. But for a service business, you only need to concern yourself with operating expenses. We then total our expenses here, subtract the difference, and that gives us our net income. And this will be our profit or loss, depending on how well the company is doing. Step 4, calculate net income or loss. So I kind of just said that already. But use the info from steps 2 and 3 to determine whether there's a net income, so the company's making money, or a net loss, the company's losing money. Total revenue minus total expenses equals net income. Okay, so the income statements that you've seen so far have just been about service businesses. Now we're going to look at income statements for merchandise businesses or retail businesses where they sell products, they sell goods that are tangible. Alright, so retail businesses have to deal with a new type of cost. It's called the cost of goods sold. So there's a new section in the expenses section of the income statement, and it's called costs of goods sold. And it means exactly what it sounds like it means. It's the cost, basically, of the inventory. So when we're looking for net income or gross profit, there are a few new steps now. In determining what our net income is, we have revenue minus expenses. This is the general equation, and this is for a service business, so where there are no goods involved. Pretty simple. When we have our income statement for a retail business, in other words, one that sells goods, tangible items, our gross profit is equal to our revenue minus our costs of goods sold. So this is the cost of the goods we sold. So for example, if we sell shoes as opposed to cleaning them, if we sell shoes, then let's say we sold our shoes for $120. And let's say the shoes that we sold cost us $60. What this means is that we sold the shoe for $120. So our revenue is $120. The cost of the shoe is $60. So $120 minus $60 equals our gross profit, which is $60. 120 minus 60 is equal to 60. Now, in terms of finding our net income, we have to take an additional step, which is finding the gross profit. So we take our $60 minus whatever our operating expenses are, and then that gives us our net income. So there's an extra little step here. Now I'll show you on an income statement what that looks like. So here's what the cost of goods sold section of an income statement looks like. It's a bit large, but it's not to worry. It's fairly straightforward once you get it. So cost of goods sold has to do with the cost of inventory that you've sold. Now, the way that you find that is by taking your beginning inventory, so the inventory at the start of the period that the income statement is covering. To that, you add the inventory that you've bought. So companies always buy more inventory so that they have stuff to sell, right? So they have an existing beginning inventory. You then add whatever they've bought during the period to that, and that gives us our cost of all goods for sale, which means available for sale. So this is the cost of all the goods that we can sell as a company. Then we subtract from that our ending inventory, so whatever we didn't sell. And the difference between all the stuff we have available for sale and all the stuff we have at the end of the period is equal to our cost of goods sold. In this case, it's $85,000. So then within the cost of goods sold section, we write our sales revenue, which we also wrote above. And we have that minus our costs of goods sold. So $150,000 minus $85,000 gives us our gross profit. And that's $65,000. Now, you can, I think in some of the income statements I have and the solutions I have, you can choose not to write this a second time. I don't want to get too much bogged down with the details because that's for grade 11. But you can write this here if you want. You don't have to. There's no reason to because we've already written it unless you'd like it just for your own process. So if you want to write it a second time, go right ahead. If you choose not to write it a second time, you just have cost of goods sold and then the gross profit, which would be your gross profit is equal to $150,000 minus $85,000, or sales revenue minus cost of goods sold. From there, you take your gross profit. Remember the steps from, Remember the steps from earlier? We found our gross profit. Now we're taking our gross profit and subtracting expenses. So gross profit minus expenses equals net profit, or our net income. 65,000 minus 25,000 equals 40,000. And so this is what the cost of goods sold section of an income statement looks like. So if you're doing an income statement for a retail business, that is one that sells goods, tangible goods, this is the new section that'll be in there. We'll have sales revenue above, and then we'll have operating expenses and net income below. Okay? All right. Now, for the owner's equity account, this is not in the income statement. This is part of the balance sheet. I just wanted to remind you that net profit is calculated first and then transferred to the balance sheet. You don't really need to know this. I'm not going to give you a question that asks you to do that. I'm just explaining that whatever's left over, the net profit, goes to the owner. It's one of the perks of being the owner is you get your net profit. So at the end of every period, the net income is then added to the capital, the owner's capital, meaning what the company is worth to the owner. If you remember, I explained that in the intro video, I believe. So we have whatever the company was worth to the owner, plus the new net income to give us our new owner's equity capital, which is how much the company is now worth to the owner. Okay? And that is it. That's income statements. Done. Man, okay. I hope you guys watch these. Take forever to make. That's it on accounting for now. I hope you found this video informative. If you have questions, feel free to email me. And yeah, that's it. I'll see you later. Okay, bye.